Hey, what's up, guys? Everybody, how's it going? How y'all doing? Welcome. Y'all know it's Tuesday, and y'all know what we do every Tuesday at 7 o'clock. We have No Risky Business Weekly podcast where we discuss all things insurance, including health insurance, life insurance, Medicare, and retirement planning, and everything in between, right? So I want to first of all say thank you so much for joining me. My name is John Davis, and I am your personal insurance advisor. And I see we have some guests with us. Miss Debbie, thank you for joining. Sister Birdsong, always great to see you. Sabu over at Snap Skills, one of the top social media managers in the game, is on the line. So today, guys, we got a lot to talk about. I hope you all are having a great week. It is Tuesday. And y'all know we do this every Tuesday at 7 o'clock on all social media platforms. So remember, guys, you always can join. This is fully interactive. Y'all can ask questions, leave comments, emojis, all of that stuff to keep me moving, okay? Now, y'all know usually I have my Red Bull, but I don't have my Red Bull today. I have actually some water in an orange cup. So, hey, guys, today we're going to talk about the power of the dime. And I forgot, I was going to bring a dime, but I forgot, and I don't have one in my pocket. So today, guys, we're going to talk about the power of the dime, okay? We're going to talk about how the dime, there you go. Y'all see that? The power of the dime. Because I don't have a dime. There's the dime on the screen, guys. But that's what we're going to talk about. We're going to talk about how the dime relates to life insurance in particular. So that's what we're going to talk about today. But guys, before we get started, y'all know we got to do the same housekeeping thing. Remember, this is a fully interactive platform, and I want you all to like this channel. And if you find some good information here, which I'm certain you will, optimistic that you will, I want y'all to share this video with as many people as you can, because my goal is to get it out to the masses. Okay, that's the plan. Guys, also don't forget, go grab my book. I think it's going to come up on the screen. There y'all go. It's called No Dumb Questions. For those of you that's already went and caught that book, I want to say thank you so much. Miss Debbie, I know I saw your name on there the other day, so I appreciate your support. We've had so many people go out and grab that book, but it's a great book. I think it's a great book. The reviews that I've heard says it was a good book. Miss Debbie, what do you think? I know you're here. It's just full of questions and answers. So it's just a book that you can use to just kind of reference some different scenarios and things like that. So please go there, grab that. Again, it's called No Dumb Question. Life insurance questions you're too embarrassed to ask. Also, guys, remember when I started this whole platform thing, I started it just on my personal Facebook page, but I'm trying to transition and get everyone to our social media Facebook group. It's called Best Tips for Life Insurance, Retirement, Business, and Medicare. Thank you, Miss Davy. I appreciate you. So, so, guys, I see we got some new people in today. Today, the topic that we're going to talk about is the power of the dime. Let's put that back up here, guys. We're going to talk about the power of the dime. I bet you all did not know the dime has the direct correlation to life insurance. And that's what we're going to talk about today. So, I want to say again, guys, thank you so much for joining me. Remember, last week we introduced No Risky Business, my new podcast. Remember, we were doing Teaching Tuesday, but I switched to No Risky Business. Tanya, thank you so much for joining me. You're so consistent and diligent and dedicated, and I appreciate you. Thank you so much for joining me tonight. So, guys, y'all see my little man right there, my little logo guy? That's the No Risky Business podcast. That's the podcast that this is now called No Risky Business. And the reason I called that No Risky Business is because every day, guys, in general, we're risky, right? Everything we do is risky. We drive, we walk to the mailbox, we have health issues, all that stuff is risk. And the point of this podcast is to teach us how to transfer that risk and protect our assets. protect our financial future, and that's what it's all about. So my goal today is to teach you something more about protecting your risks, protecting yourself, so that you can protect your financial future and your financial future. Yeah, pretty much. All right, guys, let's go ahead and jump in it. Okay, let's go ahead and jump in it. Today, guys, we are talking about the power of the dime. Okay, so guys, today we're going to talk about the power of the dime and why the dime is so significant when it comes to life insurance. Okay, and we use this equation as financial planners, retirement planners, life insurance specialists to calculate an accurate way of how much insurance you actually need, right? Because a lot of people either underinsure or they overinsure. When you're underinsured, that's kind of dangerous, right? Like you really need 400,000, but instead you take the $60,000 policy, right? And of course, some things is just normal because of budget, right? Like my budget only allows me to spend this amount of money on life insurance, so this is the amount that I can afford, and that's a reasonable expectation. And y'all know in my book, No Dumb Questions, Life Insurance Questions You're Too Embarrassed to Ask, I talk about that. What happens when you're unable to afford your life insurance premiums? But I also advise completely against over budgeting or putting yourself over your budget when it comes to life insurance, because you never know when you're going to get an unexpected bill, and then you have to question whether you actually need the life insurance or if you can afford it. So affordability is key, right? But also, if you're a person that can afford additional coverage, the dime method is going to allow you all to estimate how much coverage you actually need to protect your family, your assets, and all that good stuff. Okay. So, guys, when we look at dime, first of all, let's talk about what is insurance. Okay. Let's talk about what is insurance. So, insurance, y'all see that definition there. Insurance is a contract in which an insurer indemnifies another against losses from specific contingencies and or perils, right? Contingencies, deaths, bad health, cancer, car wrecks, perils, flood, fire, right? So when we think about insurance, it protects us against things that can happen to affect our financial future, okay? So then we think about indemnify. What is indemnify? Okay. Does anybody ever know what indemnify is? It's right there. Let me get some participation, y'all. Who's ever used the word indemnify? I've never used the word except when I talk about insurance. Anybody just randomly use the word indemnify? Probably not. Anybody? To those of you that's just visiting or just joining, today we're talking about the power of the dime. So stick with me on this one. This is going to be good. We're just not getting into it. We're talking about what is insurance. Um, Miss Debbie said no, she's never used the word indemnify, and most people haven't. I haven't used it. I just started using it recently because I talk about insurance. But y'all, when we talk about indemnify, it means to make compensation for the incurred hurt, loss, or damage immediately or in the future. And the reason this is so important, guys, is because when we think about specifically life insurance, how do you calculate how much life insurance you need? Right? Like there's not anything that tells you that you're going to spend this amount of money this year, and this year, right? So in order to properly indemnify ourselves, we have to use a calculation of how to estimate how much coverage we're going to need. And that's what the power of the dime is all about. Okay. So, guys, let's go to dime. We're going to start with the D. So, those of you that just joined us today, we're talking about the power of the dime when it comes to life insurance. And when I say dime, I mean DIME, just like quarter, nickel, dime. So, when we think about dime, y'all, we think about our debts. How many of us got debt? I'm gonna be the first one to say I have debt. Does anybody else in here got debt? I know y'all do. Some type of debt. We're talking about credit card debt, a car loan, student loans, um, any type of debt. Does anybody here got any type of debt? Come on, y'all. Respond to me. Tanya, Debbie, there you go. We all have debt, right? So when we talk about life insurance, we want it to be able to cover our debt. That's the number one reason people get life insurance. So when we think about the dime, right? We want to think about the debt. Um, the first letter of dime is a D, and we're going to use it to say debt. So whenever I meet with my client, I ask them, "What debt do you have?" And not only what debt would you do you have, but what debt would the surviving spouse be responsible for? So when we think about that, guys, we're talking about student loans that's been co-signed by someone else. Maybe an auto loan that's been co-signed, or is it multiple people on the loan? Credit cards that you may have with your spouse. That's what we're talking about when we look at the debt that's left to the surviving spouse. Okay, that's the D. Now, when we think about debt, some people don't have debt. Like I don't have much debt. Several people don't have much debt, but a debt that we're all going to occur when we pass is going to be funeral expenses. Like there's no way around it. Funeral expenses is a debt that we're all going to occur. So when we think about our debt, we want to make sure that we include our final expenses. If nothing else, if we don't have any other debt, we want to include our final expenses, right? Even if it's $20,000 to pay for funeral costs, that's a debt, and we're going to add it there, okay? So the first D means debt, right? The first letter means debt. So we're going to use our debt in the calculation. Second one, guys, let's go on to the next one. The next one we're going to talk about is your income. This is a big one because when we think about income, guys, we think about income replacement, specifically when we're talking about life insurance. So, how many of us, guys, live off of someone else's income? Like, if we're a two-person household, a husband and wife, you kind of depend on your husband and wife, your spouse's income. That's what the I stands for when we look at the dime method when we calculate life insurance. And to those of you that's here, I want to say thank you so much for joining me. Those that just joined today, we're talking about the power of the dime. We're talking about the debt. We've already talked about debt. Now we're talking about the income. This is a way that we, as retirement, financial, life insurance professionals, calculate how much life insurance you actually need. So the second is I, the income. Now, most financial professionals recommend 10 to 12 times your salary. Okay. Because when we pass, your spouse, your children are going to be left without your income. So that 10 to 12 times your salary allows for replacement of your income. So if you make $50,000 a year, we're going to say 10 times your income is going to be $500,000. It's really simple, guys. I got it right there. Multiply your annual income by the number of years dependents will need your support. That's how it's calculated. Okay. Now, let's say, for instance, maybe you can't afford 10 to 12 times your income, and that's a realistic situation. What you can do, you can look at the percentage of income that your family actually use out of your income. So you know that if you're saving 20 or 30%, if you're lucky, you're saving 50% of your income. The bare minimum that we need to do this calculation is going to be 50% your income. Now, of course, that's the method we're going to use if you can't afford the 100% of income replacement. But if you can afford 50% of the income replacement, you're looking at least 50%. And that's going to save you some money. So the second in dime, we have debt, we have income. Are y'all with me? Y'all, for some reason, it seems like I'm talking like a preacher today. Like it, I feel like I'm like talking like a preacher. I don't know. So y'all following me? We have debt and we have income. And now, guys, let's talk about mortgage. That's a big one. Let's talk about mortgage. So we have debt, we have income. Now we have our mortgages. Now, when we think about debt, guys, when we calculated the debt, we didn't include the mortgage. If y'all notice, I didn't say your mortgage payment or your balance of mortgage. Okay. So when we think about mortgage, there you go, Miss Debbie. Stay with me. Stay with me, Miss Debbie. When we think about mortgage, guys, we're talking about what is the balance of your mortgage. All right. If you're married, if you have a spouse, if you have children that live in your home and you want to keep them there, we want to make sure when we calculate how much life insurance you need, we want to make sure that we include the balance of your mortgage. So if you purchased your house for 400,000, you paid it almost down, now you're at 300,000. We're going to make sure that we include that 300,000 in your life insurance policy amounts. That way if something happens to you, we're going to pay off the house, right? So remember, we're covering your debt with our D for dime. We're covering your income, right? That's our I in dime, 10 to 12 times. Then we're going to pay off your mortgage, right? However much your mortgage is. Now, let's say, for instance, we're in a case where we can't afford the full mortgage payoff amount. We're going to use that same equation, guys, and we're going to say what is the percentage of your income that's used to pay the mortgage compared to your spouse. So if your mortgage is $2,000 a month and maybe your spouse is dependent on at least $1,000, we're going to use that $1,000, or we're going to use 50% of the mortgage payment, and we're going to look at how long you have left on your mortgage. Okay. And that's how we're going to calculate how much insurance you're going to get based on the need to pay off your mortgage. Are y'all following me? Let me know if y'all follow me. So those of you just now joining, remember we're talking about the power of the dime. That's what we're talking about today. And y'all see at the bottom, we see it scrolling. John is available for life insurance policy reviews, guys. That is me. I'm available. If you've never heard of this method, or if your insurance agent did not go over these numbers with you guys, it's time to do a policy review. Okay. Because this is important that you all understand this. So we know we got our D for debt. We got our I for income. Then we have our M for the remaining portion of your mortgage. And then finally, y'all, we have our E. And before we even go there, hold on. I was going to ask you guys, what does the E stand for? What does the E stand for? Y'all already just saw it. I know y'all saw it. Let me see them, Sabu. Let me see. Let them see me, rather. We're going to talk about the E, guys. We're going to talk about the E. Now, the E stands for education, because most people nowadays, if you have children, you understand that educational cost is high, right? Like, we think about universities, we think about colleges. We're going to put up that screen so I can show you what I'm talking about. Y'all see that? So when we think about education for our children, if something were to happen to me today and I have a 2-year-old child or a 3-year-old son, I want to be able to assist him with college education or private school or trade school or any form of higher education, right? Like, some people go to a private school, elementary school, junior high school, that has to be paid for. College has to be paid for. Private school has to be paid for. Any form of higher education or any form of education that costs has to be paid for. So we're going to include education in our equation. Okay. So if again, the question that I'm going to ask you when we talk is, how much of your children's education do you want to be responsible for? How much of your child's education do you want to cover for them? And we're going to use those numbers in the equation. Okay. Are y'all follow me? Y'all have any questions about dime, debt, income, mortgage, and education? Any questions? Let's throw up the entire discussion of what we talked about, guys. So your life insurance policy limits are based on your debt, your income, your mortgage, and your education. That's going to cover your spouse and indemnify them. Remember, indemnify means to make whole, right? To recover from loss. So if something happens to us, our spouse still has our debt, right? They're still losing our income. They still have their mortgage, and they still have my child's education. So by combining all these numbers, guys, we're able to give an estimate of how much life insurance you actually need. So, for example, guys, I know y'all are probably thinking, how can I afford $900,000 in life insurance coverage? I'm gonna take that screen down. I'm gonna talk to y'all. All right. So the question is, how can someone afford $1 million in life insurance coverage? Right. $800,000 in life insurance coverage, and that's a good question. So I worked out some equations, and y'all know on Facebook and other social media, LinkedIn, I usually try to post examples of clients that I've worked with that week that just had an intriguing story or really was proactive in getting their life insurance together. So I did a little equation, and I'm gonna call this woman Shirley. All right, let's talk about Shirley. Y'all with me? We're gonna talk about Shirley's life insurance plan. Okay, so I met with Shirley last week, and I sat with Shirley. We talked. She said her debt was only about $5,000. Okay, so she didn't have much debt. She had $5,000 in debt, and then we added an additional $20,000 on for funeral final expense costs. Okay, so right there we're at the 20. We're at the $25,000 range. There you go, Tanya. We talking about Shirley. Shirley is a 35-year-old lady. Okay, she's 35 years old. Shirley has two kids. Yeah, Shirley has two kids. 35 years old. She makes $50,000 a year. All right. Shirley has only about $5,000 in credit card debt. We're going to add an additional $20,000 on because remember, whenever we pass, there is debt that we have. If nothing else, final expenses or funeral costs. Okay. So at that point, if something happened to Shirley today, she's going to have about $25,000 of debt left. All right. Now, remember, guys, Shirley's income is about $50,000 a year. So we're going to remember most financial planners, retirement planners say that your life insurance, you need to have 10 to 12 times your annual pay. Okay. So that's going to put us at $500,000. That's going to give her surviving spouse about $500,000 as replacement income. And y'all know, I don't know if y'all know this or not, but I'm a writer. I write everything. So I know all this and I've written it like 3 or 4 times, but for some reason I'm writing it again. I don't know, it's kind of weird. So we have $25,000 in debt. We have $500,000 in income. And then she has a mortgage payment, guys, of about $300,000. That's the balance of her mortgage. So we want to make sure that her husband is able to keep the house, keep the two kids happy in the home. That's $300,000. And she just wanted to give $60,000 to each child to cover educational expenses. That's about $120,000. So I estimated for Shirley that she needed a policy of about $940 to $950,000 in life insurance coverage. Now I know what y'all thinking, Tanya, Miss Debbie. I know what y'all think. That's a lot of insurance, right? But based on the numbers, it legitimizes why she needs those coverage limits. Okay. So based on this 35-year-old young lady, I'm gonna say young lady because I'm 37 and I feel young. I'm young. All right. Her monthly premium for that life insurance is only $66.67. That's it. $66.67, guys, is going to give her 900 and about $50,000 in coverage. I know, Tanya. Right. It's a lot of coverage, Miss Debbie, but it makes sense, right? Yep. So, how you guys should be calculating your policy limits. Now, if you're not doing that, I got a slide for y'all. It's a pretty slide, too. How did you choose your policy amounts? Y'all don't have to answer, I know. But that's a good question. If you simply went out to an insurance person and said $100,000 because it sounded like a lot, but then you use this equation of dime and you recalculate everything, you're probably going to need more than that. And again, y'all remember these numbers aren't etched in stone. So based on your income, based on your budget, you can adjust those numbers, but at least you know what the appropriate amount is and you can work towards those if you want to. But if your agent or if you're getting with someone or you calling over the phone and they're simply telling you to take $300,000 because it's the cheapest or it's the easiest to qualify for, be very careful because in that case, we're underinsuring, right? And the whole point of insurance is to make your spouse whole, right? We want to indemnify them from their losses. So using the dime method allows us to do that. Okay. So guys, do y'all have any questions about the dime method? Y'all have any questions about the dime method? I'm with y'all if you do. So those of you all that's just now coming in today, guys, we talked about the dime method when it came to life insurance. We talked about calculating your debt, your income, your mortgage, and your education to get a full round view of how much life insurance you actually need. Now, again, guys, if you need a policy review, and I always say to all of my clients, get a policy review every 2 years. If you're more proactive, get it every year. But every time you have a lifestyle change, guys, we need a policy review. If you have children, if you have a new baby, if you buy a new home, right? If you notice that you have a lot more credit card debt than you had when you were initially married, let's do a policy review and let's recalculate those numbers. It may just be an additional $10 a month. Or in some cases, we may need to lower your coverage amounts. And if that's the case, we can do that and save you money. But at least you know. All right. So don't keep the same policy that you had since 2005 without a review. And I say that for a couple of different reasons. For one, we want to update it, the policy amounts. For two, we want to update the beneficiaries. Things happen, marriage, death, kids get older. Um, yeah, there you go, Tanya. That's true, right? And then we want to do a policy review. If you all have an agent or if you have signed a policy, it's good to get a policy review from someone else because they may point out things about the policy. Yeah, absolutely, Miss Debbie. They may point out things about the policy that you just didn't know. Sometimes it's like minor mistakes that the normal person that's not educated in insurance wouldn't even notice. So y'all see my information down there below. I do policy reviews. We can do some. Y'all can send me a DM. Y'all can call my cell phone there. We can schedule some time to talk and recalculate your numbers to make sure you have the correct policy limits. Okay. So, guys, listen, if y'all don't have any questions, I want to tell you all thank you so much for being here. Give me 1 second. Let's see. There was one more slide, guys, I wanted to go over with you. Let's throw that up there. 1 second. I think I covered them all. Yep, I did cover them all. So listen, guys, before we jump off, I want to say thank you so much for joining me. Remember, don't forget to like and share um, all of the posts that we have. You can go to our YouTube channel. Guys, let's throw that YouTube channel up here if we have it. And remember, guys, that you all, yeah, Tanya, give me a call and we'll do some policy reviews. To those of you that have multiple policies, like Tanya said when she locate her policies, y'all remember we talked about the red folder. So make sure you all have all of those policies in a red folder. Um, and if it's possible, we may be able to combine those. Okay, we may be able to combine those policies into one policy instead of you having multiple policies. Okay, some people just have multiple policies, and that's okay. But if we can combine them down to one, that'll be good. Guys, don't forget, please go out there, support me. Um, the book is right there. It's called No Dumb Question, Life Insurance Questions You're Too Embarrassed to Ask. I'm gonna leave that link. Y'all know I always do the wrong hand because this the hand that y'all can't see. Y'all, y'all know what I'm saying. Right there. All right, there you go. So boo, y'all, you know he's always correcting me. Right there, because y'all's right is my left. So I'm right-handed. It's always confusing. So y'all go get that book. It's called No Dumb Questions, Life Insurance Questions You're Too Embarrassed to Ask. Also, y'all guys, don't forget to join the Facebook group. I'm gonna be a lot more active on that group in the next week. I'm sorry, y'all. I've been busy traveling. I was in DC this past week, and then last week I was in Nebraska with Ben. Y'all remember Ben? I was in Nebraska doing some training with him to make sure I bring good material to you guys. So hey guys, thank you so much for joining me. I've enjoyed you. Remember, we're meeting here every Tuesday at 7 o'clock p.m. We discuss all things insurance. It's the No Risky Business podcast, guys. If you notice down there, Sabu just put it up. I have a new form. You can click on that link, guys, and you can fill out an appointment request form, and I'll have everything I need to do an appropriate quote for you. So when you all call me or you all DM me, I'm gonna send you that form. It You can do it on your phone. It takes 2 minutes. You fill it out. It comes right back to me, and then I'm able to go in and work some numbers even before we talk. Okay, so it's a good resource to kind of speed up the process of getting insurance done. Y'all see my information right there. DM me, text me, call me, all that stuff. So hey guys, thank you so much for joining me. I've enjoyed you. I'm about to go eat because it is 7:37 and I haven't eaten all day. So thank you so much for joining me, Miss Debbie, Miss Ruth, Tanya. Thank you all for being here. I look forward to seeing you guys next Tuesday at 7 o'clock p.m. We talk about all things insurance, right? All right, guys. Thank you so much for joining me tonight. Y'all have an amazing day tomorrow, okay? All right.